Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. Thanks for joining us today. If you've been tuning in recently, lots going on in the property market at the moment. A lot of flux, flux being a lot of noise around the media, around what's happening to property, what's happening with lending, what's going on with the banks, what's going on with the Royal Commission, what's going on with everything. And it's one thing that's happening in property investment right now is that a lot of noise, chat a lot about how us as property investors can navigate this. And, I always say, concentrate on those things you can control, be aware of what you can't control, but make sure you're making the right decisions. Hopefully this podcast and podcasts that we do with Smart Property Investment can help educate you so you can make more informed investment decisions. One thing I really want to chat about, we've touched on it recently, but not in depth, it's lending orientated. Now, you would think at the moment that banks don't want to lend you money because of increased legislation or requirements around how they're looking at your serviceability to secure debt. And you would think that they don't want to really provide any debt financing to investors. That's wrong. Banks do like lending money. A lot of the value of the banks is the fact that they have very strong mortgage lending. It underpins in many ways the value of our banks, their profitability. So banks want to lend you money. It's just a little bit harder to secure money at the moment. We've touched on it for probably well over a year or two now around the APRA lending requirements to try and slow down lending to investors, and it's taken its impact. Markets are slowing down in parts of Australia, but I'm not going to get into that today. What I want to touch on or dig deep into really is it's a bit of a scenario which you might not have thought about yet, but you need to start thinking about it if you're an investor, particularly if you have a portfolio with multiple properties on it. And this is around interest-only lending and the fact that a lot of interest-only loans are going to expire over the next couple of years, and you may not be able to maintain your portfolio on the basis of still having interest-only loans, i.e. you may need to switch to principal and interest repayments, which is going to be going to change the cash flow makeup of your property. And for many people, if you are over-leveraged, you may struggle to hold on to your portfolio. So we're going to chat about that today. I've got someone in the studio here who's going to help me out with this, who has written a bit of a research paper on this recently. He's a good friend of the Smart Property Investment Show. I've known him personally for many years. Aaron Christie-David. He's a mortgage broker. He's also a passionate property investor. And I've got a bit of paper here in front of me, and he looks like he's won about 1 million awards around mortgage broking. Aaron, how you going, mate?
Great, thanks, mate. How you doing?
All right, so I've set the scene, and we're going to get into this interest-only stuff. But you've got more little medals here next to your name than I've seen for quite some time. Why are you winning all these awards for?
Mate, I'd love to say it's all me, but it's a huge team effort, right? I'm in business with my wife, and I think she's the one that keeps us on track to keep going year-on-year growth. But I think part of that's been we hit a sweet spot with a lot of clients. It's give them good old-fashioned service, back that up with a bit of knowledge as well. They tend to do well. They refer, and we've done well off the back of that, mate.
So you're a mortgage broker. Tell me just a little bit about your business. How long have you been going for?
Yeah, Tilly Wealth has been running for just over 2 years.
Yep.
I've been broking for 4 years as well. So in that 4-year space, seen huge amounts of change in lending, seen huge amounts of change kind of in our own clients' lives as well. This is what we do, right? We live, breathe lending. That's all we do. We do nothing else besides lending. So we tend to stay in our lane. But I think one thing we've done well is also have good partnerships, whether it's buyers agents, depreciation, solicitors, accountants, financial planners. One thing we're really big on is we advocate the team. So how do we get the team on board that's going to help clients win? And again, all those things are just helping us take the business to the next level, mate.
That's cool. And you're pretty active. Whenever I sort of rock up at property-related stuff, you're normally there sort of keeping your sort of finger on the pulse of what's going on and maintaining your education and understand what's going on. But I know education is pretty key for you, and you've got a bit of a beef at the moment around this interest-only lending stuff. You've put a paper together, Beware the 2020 Interest-Only Danger Zone. And I'll read the first couple of paragraphs just to give our listeners a bit of an idea of what's going on here. You've written, it's the impending danger zone that many of the 1.5 million affected borrowers are doing their best to ignore. From 2018 to 2021, an estimated 200,000 interest-only loans totaling $480 billion are due to expire and will reset to principal and interest loans. For the average investor or owner-occupier, that means a pretty significant hike in your repayment, or what the Reserve Bank of Australia has called non-trivial sum of about $7,000 per year. So what you're saying is that a whole bunch of loans about to reset the principal and interest, and it's going to cost essentially $7,000 a year to carry this. So that's pretty much what it's all about.
Yeah, man. I think we've gone back and said, look, 2014, 2015 was a peak of interest-only lending. Typically, it was a 5-year period. You mentioned before about kind of seeing each other. We're at the Pippa breakfast, which they said, an average investor will hold their property for 5 years, which then caused me to think about this, going, people bought at the peak of the market when lending was easy, and they're going to choose to sell when, I guess, the market's flattened out or it's tougher. That's going to put them in a real bind. So then we need to think about what's the strategy as well. And that's where really that's when this article comes from a place I love to say, if you bought this property for a reason, stick to your guns, because I guess the game plan's changing a little bit from what the banks are doing. Yeah. But you really need to get comfortable in your own skin to say, I bought this property for a reason. We're about to come into a bit of a storm, and not in a negative way, but just it's for everyone. We're all going to go through it. What do I need to weather this storm a little bit as well?
So you've written here, once seen as somewhat of a magic bullet by Aussies, interest-only loans at their peak accounted for 40% of all loans. With lower repayments, they allowed homeowners to finally get a foot on the tightly held property market. For investors, it was a way to maximise tax deduction, enhance cash flow and build up their property portfolios. But this traditional way of investing just doesn't fly anymore. Lending standards have seen a significant amount of scrutiny by the banks, which has impacted the approvals of new interest-only applications. So 14-15 was the peak of lending of interest-only loans. So we're now 2018. So 14-15, most people get a five-year interest-only period. So what happens after that 5 years is that it reverts to principal interest, unless you renew it back with the lender to go extend it out again for another 5 years.
And I think one thing we've caught people unaware of is it actually rolls onto a 25-year P&I term, not a 30-year P&I term. So your payments actually jack up significantly compared to when people work out the numbers, they go into a 30-year P&I term. Those 5 years are invisible. It's a 25-year P&I term now as well.
That's an important point. So rather than paying off the loan over a 30-year period, you've got to pay it off over a 25 period.
If you can't refinance it, but then what you've done is you've extended your loan term out again. So what's the strategy here? And was this set clearly from the beginning as well, that you knew that if you did have to go to P&I, was it going to be over a 30-year term or 25-year term as well?
So you're a property investor?
Yep.
How long have you been investing for?
I bought my first property maybe 8 years ago.
Okay.
I've sold it. That was in North Parramatta in New South Wales. We've bought properties since. But again, we've always had this, our focus has been what are we buying and what's the purpose behind it as well. Naturally, capital growth has been easy to get in New South Wales. But I think one thing we've really focused on is how do we maintain cash flow moving forward as well.
Okay, and what we're talking about here is when your loan shifts from interest only to principal interest. It's a cash flow situation where if you can afford it, great. If you can't afford it, you're in problems, and that's going to put stress on you. So can you just explain how and why loans coming off this interest only period, why is it happening? Why is it going to be harder to not be able to extend your interest only loan at the point in time when they expire?
There's probably three things here, Phil. I think one is lending has got a lot tougher. So if we go back to 2014-15, lending was freely available, so credit was freely available. Now that's tightened up, which in then turn we're seeing kind of a drop in demand for property because supply of credit's got a lot harder as well. So if you're going to refinance, some people are finding it tougher because they may be taking on a car lease. Banks have got a lot more scrutiny around living expenses. That wasn't around in 2014, 2015. So lending naturally is kind of tightened the screws, so people find it hard to get lending. The second one is around rents as well. So we're seeing a lot of supply, and over the next 2 years, we're seeing record number of unit supply coming onto the market as well. We've seen very little growth in rent, and after the latest CoreLogic numbers as well, we see that again to be true around stunted rents increasing. And the third is around capital growth. So people that are kind of banking on growth, again, with new supply coming onto the market, we're probably seeing less capital growth. So to me, that you overlay all those three and you've got a real combination of kind of headwinds for people, which you pull the crystal ball out 2014, 2015, you could never have seen coming perhaps as well.
So if you want to extend your interest-only period moving forward, it's just not really tick and flick and the bank goes, yes, you essentially need to do a whole new application. Is that how it's going to work?
Spot on.
Okay.
Yeah, it goes back through credit assessment. And right now, credit managers are looking for reasons to say no rather than say yes. So we're stressing to people, be upfront with all your documents, be upfront with all your information. Don't leave anything undisclosed, because that's just going to put you in a really bad position for them to start saying yes to your deal as well.
So they still will extend interest-only periods. It's not like they've banned them completely, right?
Mate, there'll always be a market for interest-only loans. And that's, again, what we're trying to stress here. This is not some type of clickbait headline. This is not some type of fear-mongering. It's actually more empowering than anything to say banks are going to be offering interest-only lending. Brokers still getting loans approved as well. But you need those two to work hand in hand. You need to find the right broker to find the right lender for you rather than chasing a really low rate, which you can imagine when everyone's going to that bank with a low rate, that bank gets to be selective about who they take on as well. And if your broker hasn't packaged your deal up correctly, it may not actually fly with them as well. Now you've got a hit on your credit file. So too much activity as well, we know it doesn't look really good for the next lender.
So why would you use an interest-only loan versus a principal interest loan in this current market?
Cash flow could be one. So if you're still in that fairly aggressive phase of growing your portfolio, it could be one. You could be looking to pay down your own rock property as well. So again, there's a reason for it. I mean, they're probably the big ones that I'd see if someone's going to sit down in front of me and go, why interest only? And we have to justify that to a bank as well. So if it's going to interest only, a lot of our notes also have to, I guess, justify why the clients are going to be at interest only. Some have really good astute financial planning or accounting advice as well. So that kind of fits into their strategy around maybe they're investing in shares, managed funds, into the SMSF. So it has its place, but not just for everyone, that's all.
So what's the benefits then of switching your loans to principal interest?
You get to pay down the loan. And quite honestly, if you do some of the numbers around a higher interest-only rate versus a low P&I rate, sometimes it's not too far off. So you could choose to start paying down the debt while it's still cheap. Because I think in a few years' time, we might kick ourselves going, mate, rates were under 4%. We almost missed the beat there to pay down some really cheap debt, for example. So you could do that.
Well, I'm happy you brought that point up because I wanted to chat about it. So there is disparity between the rates you're going to get as a principal and interest loan versus an interest-only loan. And that could be up to 1% different.
I mean,
plus.
We can't even keep up with the rate cards ourselves at the moment. I mean, you've got lending that's based on interest only versus principal and interest, variable versus fixed, LVR. So if it's over 80%, 80 to 70%, sub 70%. So banks have different rates for different appetites, mate. So depending on where your LVR is, what your loan balance is, P&I versus interest only, it could be a different rate. So that's where it really helps kind of have that broker in your corner say, look, here's your rate options.
Just kind of know. So what you spoke about there, so you're going to get a different rate if it's above and below 80. So how big is the LVR? You're going to get a different rate. Whether it's fixed or variable, you're going to get a different rate. Whether you're an investor or an owner-occupier, you're going to get a different rate.
Balance.
Whether it's the size of loan balance, you're going to get a different rate. Whether it's interest only versus P&I, you're going to get a different rate. So like that's 4 or 5 different variables.
Correct.
Which are going to influence the rate you get. So for a lot of people, when they go out there, and you should probably see it all the time as a mortgage broker, they go, I just want the cheapest rate. Well, the cheapest rate depends, they might see something marketed on TV at 3.99%. They might not ever get that stuff. I look at some of our loans that are up over 5% because we invest in a trust.
Yep.
Again, different again, right?
Mate, I use the example that it's like seeing a cheap flight to Singapore, for example. It'll take you 30 hours to get there, but it's cheap for a reason sometimes as well. And no different to an interest rate, just like how a mortgage broker and a travel agent, very similar. We want to get to the same destination. Our job's to filter through and go, look, if you want to get there as quick as possible, here's the lenders for you. And sometimes, they'll dangle a really low rate and then put you through so many hoops that it's not even worth trying to chase the rate, for example.
But that's it also as lending obviously is getting tighter. It's a period of transition. But during market conditions like this, often a lot of lenders will sit there and use it as an opportunity maybe to look to acquire new business. And that's a bit of an industry term, right? But if the Commonwealth Bank or ANZ, for example, is put their rates up and, that might be an indication of their appetite to lend at a particular time. It can change by the day or by the week. Some lenders might sit there and go, you know what, we've got capacity to take on some business right now. So therefore we'll offer a pretty sharp rate for interest only for whatever period. That's how it works. But really only a mortgage broker is going to know about that stuff, right?
That's right. I mean, for anyone else to try and keep tabs of it, we've got a specialised person in our office that just looks at credit policy, for example. So we need someone dedicated to look at rates and policy that changes on a weekly basis, for example. So I can only imagine how much confusion that causes for investors and consumers out in the market as well. And I think the other part is, get very clear on what lender you're going to. So, I mean, lenders are dangling what are they doing at the moment? $2,000 cashbacks, for example, $1,200 cashbacks. So they're trying to win new business. And I think people kind of get their nose out of joint when they go, my current bank isn't honouring what these new banks are offering. Yeah, because after about a year and a half, 2 years, you've got economic value to a lender. They're happy to lose you and to win new business as well. So I think as harsh as it sounds, it's not you, it's them.
Yeah.
And I think use a bank like they might use you. And yeah, if it's a better lender, if it's a cheaper rate, if you can get a refinance rebate, brilliant.
Yeah.
But it's got to fit within your strategy as well, because you just can't keep jumping from bank to bank as well.
Do brokers get annoyed having to getting someone calling out going, I'm with this bank right now, I don't think I'm getting a great deal. Can you work out whether it's a good deal or not? You might not. If you come back saying it's a pretty good deal, you don't get paid, right? So how does it work with you guys? Or is that the stuff you like to do because that's where you can add a lot of value?
It is. I think what we love to see is people that have a strategy. I'll go back to this. It's like telling a chef I'm hungry, and they can keep bringing out dish after dish, mate. But until you say, I want Italian or I want tomato sauce, for example, as a base, how are you going to have a clear brief? So if an investor is very clear on what they would like, or want a little bit of guidance, for example, that's our role. So the broker's role is really two things. One is let's get very clear on your strategy. What are you looking to do? What do you need to do to get there as well? And how can we help you get there? And the second part is then navigating the whole home loan process. So how do we make this an enjoyable experience? But also how do we know the little nuances that you're not supposed to, because we do this on a daily basis as well.
So if you're listening to this and you haven't really thought too much about, I got a lot of interest-only loans and I don't really know when they expire, or I don't know the impact of if they do expire and I can't extend them at interest-only period, what do you do?
Yeah, have a chat. If you've got a broker, go back to them, get them to call the bank. That's why we paid a trail commission, is to be your account manager going forward with this as well, to let you know when you're rolling off that interest-only period. If you're fixed, when does your fixed rate loan expire as well? Again, pick the team wisely. That's their job to know. So one call to the bank will tell us exactly when your loan's due to expire on interest only or fixed, what options they can do to kind of retain that business from a pricing point of view. And if that's not competitive, then casting it out wide to see what other lenders you could approach as well. So
if you're 3 years into a 5-year interest only period, can you extend it at year 3 for another 5 years?
You could if you switch banks. Now
you switch banks.
Yeah, that existing lender may be less likely to roll off. And again, most lenders are under their APRA cap. So that's not really the issue here. But
sorry, could you just explain the APRA cap? We've spoken about it before, but just refresh everyone. Yeah.
So they got a 30% cap on the interest-only portfolio. So a bank, let's call it Commonwealth Bank, for example, 30% of their loan book can only be interest-only. And if you start to look at, inside my chart pack here, we've got which lenders have got massive exposure to interest-only loans. Westpac's probably the biggest one, which is why you see a lot of scrutiny. Westpac has come back just of yesterday, just recently writing to some of their customers saying that they need to take their loan somewhere else, right? This is uncharted territory that we're kind of heading to, where banks, they've copped a $35 million fine, which is getting fought out in the courts at the moment. You see some banks taking some pretty drastic measures with due reason. It's due course, mate, because they're trying to cover their own butts as well.
Yeah.
I tell her this about banks. I said, they'll give you an umbrella, and when it's raining, they'll ask for it back.
Yeah.
So as much as the banks are using you, I think you need to kind of be savvy with your own finances and say, well, this bank's not right for me, or they're going to start to turn the heat up on us a little bit and tell us to go refinance somewhere else. So instead of that happening to you, why don't you take action, be proactive, and kind of manage which lenders you're going to go to before everyone's going to have this mass exodus from Westpac, for example, and then trying to find another lender. And then we've got a glut of applications going to that next bank as well.
So this is stuff you can control, right? You can't dictate what banks are going to do, but you can work out how you're going to work with it. Are any of your clients, one of these Westpac customers, being told, look, we don't want your business anymore, move on?
Fortunately for us, they're not. But we've had a few clients actually called by some banks trying to shut down their lines of credit. Okay. Yeah. So for us, I'm like, look, mate, we had that there for a reason. Don't close it. And they're offering financial incentives to shut those. Obviously,
really,
there's that's a liability for a bank to have a large line of credit.
But they've got to keep capital against that, right? Even if it's not drawn down. So, yeah, it's bloody complicated, right?
It is, and I think that's why the banks love it, mate. Complexity, I guess, is fearful for people. And when there's fear, that what action do they take? And sometimes they don't take any action. So what we're trying to say is take the fear away, because if you're investing, that kind of puts you in elite company already, because not every Australian will kind of go down this path. And then we see the kind of the top 1% of investors, how have they got there as well? So we're trying to analyze them. And to me, it's not that they've been lucky or they've bought the right properties. To me, it's all about their psychology and their relationship to money and debt. If they feel, I guess, in control, if they feel they've got the right team around them, if they feel they know their strategy, if they feel they know what the end's going to look like, they're not worried about maybe some basis point, some increase in interest rates. they're going to hold through it because they know that they've got the right mindset to then achieve what their original investment goals were compared to the people that are selling their property after 5 years and maybe not even realizing a gain.
Yeah, well, this is that pain and gain report that CoreLogic does. Most people have pain in property, i.e. they sell a property for less than what they bought it for. It's not people who have held on to the property for 10 years or 20 years, right? They're the gainers, right? The pain people are people who have had to sell not too long after acquiring a property. And often they need to sell because of maybe life circumstances, but in many times it's because they can't afford to hold on to the property. And
it's a real shame, mate, because and then what happens is they have a bad experience and they tell everyone they know about their bad experience in investing in property, which then deters other people, puts fear in other people. A lot of it's sentiment driven, right?
Property market, a lot of it's sentiment driven. When everyone's making money, everyone loves property. When someone, a mining town goes bust and you hear all these people have blown their dough, that's only a very, very small part of the market. But
and it makes a great media headline. It makes a great story as opposed to the thousands of investors that do so well that fly under the radar. And I think we should be sharing more of those good news stories rather than festering the stories about mining towns. We always knew that was going to be a speculative bet.
Yeah.
What was the reason that people invested there or bought too many properties there as well?
Yeah. So some of the madness that happened in mining town investments sort of 3-4 years ago is just absolutely bonkers. But anyway, that's what we're trying to do here on the Smart Property Investment Show is to hopefully give you some information so you try not to make those mistakes other people may. But so do you mainly deal with investors or owner-occupiers?
Yeah, so in our business, we have 3 big niches. One is investors, the other is self-employed and SMSFs. Okay. And again, very technical, three niches that we've got. And I think that's what you need to start doing is specializing. See some brokers actually start to specialize in particular areas of lending. Yeah. Just because if you're trying to be a generalist, to me, it limits your ability to kind of cut across that many lenders.
SMSF lending's got tough, right?
Absolutely.
Everyone's out of it. Now, who's left Macquarie and AMP? You can pretty much guess.
AMP's out as well.
AMP's out.
Yeah, so you start to look at it going, I always say this to people, if you're starting to recall a product or stop selling a product, was there something wrong with that product? If I use an example, if Toyota stopped selling a vehicle, for example, was there an issue with that vehicle? And lenders have stopped selling, effectively, this is SMSF's a product, right? They stopped selling that product. Is there something wrong with them? When we've called a few banks, because we did a fair bit of SMSF, we're just reviewing it. We're going through some due diligence processes. And I just think, is that a bank's way? Is that their language of saying, actually, there's more risk in these loans than we anticipated, for example. And so that window of SMSF is just starting to close up a little bit. So,
well, they're just not as economical in terms of, I guess, I'm not an expert on SMSF lending by any means, but banks will channel their money into products which make them the most money, right?
Spot on.
Let's in the simple speak, right?
A bank never put out a product they don't make money on.
No, absolutely. Sure. And SMSF lending, for what I understand, requires significant more capital be put aside in order to provide SMSF lending. So it's a big challenge. So they're sitting there thinking, shit, we've got to hold more money in order to do this. Yes, you make a bit of a premium rate, but there's more risk associated with it. And obviously legislation coming out of government pretty focused on SMSF lending right now because of potentially, over the last couple of years, people sort of taking on self-managed super ones, but probably they shouldn't have, right?
9 out of 10 SMSFs are non-compliant at the moment.
Is it 9 out of 10?
Yeah, so that was latest, I think, ASIC numbers that came out. So, mate, we've seen SMSFs that have been set up well, that have done very well. Yeah. And I think there's always a place for good SMSFs. People that have bought well, sometimes they're lower LVRs. So we're talking about 60, 70%. They're P&I, and they're getting jacked on the rate as well. So the banks tend to make a fairly good margin on those rates. They're charging enormous fees as well in terms of legal fees, in terms of setup costs as well. And typically our clients that have SMSFs are more astute. That means they've got an accountant, they've got a financial planner, they've got a strategy in place as well, and they're paying down the debt and they've got good super balances. So from where I'm sitting, we like SMSF clients because they tend to be far more astute and far more confident in their own skin as well because the team around them has set a strategy that they all agree on as well. Yeah.
So you deal with a lot of investors, whether it's inside or outside of super. What are the 3 things that you see the best performing investors, the best performing portfolios? What's some common traits that they share?
Yeah, to me, the number one is their mindset. Call it psychology. In our business, we call it state of wallet, state of mind. So to me, the ones that have their, the things done are right, so budgets, cash flow. Now, they shouldn't have to know this off by heart. That's what their team around them's for. So they've got their finance broker on speed dial. They've got their accountant, depreciation specialist, the right teams around them to support them. So I guess they can sleep better at night knowing that their portfolio is taking care of themselves. The second point lends itself to point one, which is having the right team around them. So if you can imagine, if we're doing, just like I run my own business, I need the right team around me to do my annual reviews, to see where my numbers are going consistently. And that's what they do as well. They've got a good team they can rely on. And the third one is they've got a strategy and they stick to their guns as well. It's not chasing shiny objects. They're not chasing a mining town or a flip or a development first up. For example, that first property is a cornerstone in their portfolio. They're going to do very well off that. And they're going to take advice or be open to advice, say from like a buyer's agent, to say, look, here's the property that we're buying. Here's the strategy to hold it for 10 years. And over that course, we can start to leverage that property if it's starting to do it really well.
So chatting about interest-only periods coming off, are you proactively speaking with your investor clients around this, or are they coming to you? Like, how's it working? Are most people not too sure about it, or that's not on their radar? Is that a fair assumption, or the good investors don't know what's going on? Yeah,
the good investors are. They have it on their radar. Again, we're trying to do everything we can to get our own clients. I mean, we need to look at our own backyard to make sure our own clients are taken care of. But to me, it's a general message. You know, this has gone out to the mortgage broking industry. It's going to the investor community as well. We're trying to make sure that we just raise awareness of it, because what's going to happen is you're going to open the mail, you're going to get a letter in there saying that your interest-only loan is going to roll off in 3 months, and then you're going to start to act pretty quick. And you can imagine if a record number of interest-only lenders, borrowers are getting the same letter, they're going to do the same thing. So everyone's going to panic a little bit. Yeah. So what we're trying to say is don't dig your head in the sand. Get on the front foot, work out your options now, because if you need to readjust your budget, at least you've got kind of 12, 18 months to start pulling the purse strings now, rather than when lending gets tougher as well.
Well, in the paper you put together here, subhead is options to make it through the danger zone. You've given 3 things you can do if you're in this situation with interest-only loans coming off their interest-only period. You said number 1, make peace with principal and interest. The second one was to sell up, or third one is to increase the rent. So you can either get out by selling your stuff, or just get on with a principal interest and work out how you're going to absorb the increased cost, or you just put your rents up, right, to help you cover some of the cash flow. And that might not be possible. You might not be able to, because, another point you've made here is, rental income is softening, and it's a lot more increased supply of properties coming on the market. So you might not be able to sell at the price you need to, and you might not be able to put your rents up. So sometimes
we're
you've got to cop it on the chin.
And that's what we're trying to say. The last 2 options are there pretty much just so we can cover off those bases. But what we're trying to tell people is, if you have to go to P&I, cop on the chin. Many other investors will be as well. But yeah, I think what we're trying to say is, if you don't need to sell, you don't have to sell, don't hold on to it. You bought it for a reason. You paid stamp duty, you probably paid a buyer's agent, all the costs, holding it, and then to sell it as well, probably doesn't stack up. The numbers, if you bought, in that last 5-year period, it's not going to stack up. And like you said before, mate, the people that bought 10, 20 years ago are the winners. Yeah. So it's kind of having that long-term vision to go, I'm going to hold it through this, call it a pain period, but we're going to come out of this a better investor for it as well. So work
out how you can hold it by adjusting the cash flow situation that you have associated with it. So, but if you bought property at the peak of the market at 90% LVR and properties come down a little bit, a lot of people might be in negative equity, right? It's only really an issue if you need to sell that property. So
that's right.
Work out how you can hold on to it. With interest-only loans coming off and you need to shift to P&I, actually do the sums with your broker. I'm sure they can help you out of what would happen. And you got to remember also, if you're paying principal interest, it means that you're paying down the principal. So why do you invest in property? You invest in property for wealth creation.
That's right.
So how do you create wealth through property? Well, the idea is to own a property and not have any debt against it, right? So it's actually helping you along that path. You got to pay the principal off at some point in time.
And I think a lot of investors start out going, look, I want to have that passive income stream coming in. I'm like, well, how would you do it when you've still got investment, interest-only loans, 20 years down the track even? That doesn't fly.
Yeah.
And that's what we're trying to say. This could be that little window here that people pay off the debt, and then they're starting to get that, that positive income that's coming in that's going to supplement their wage and, pays for a holiday or pays for a lifestyle.
And I guess the sooner you start paying off the principal, because what happens with a principal interest loan, you pay the principal part at the start of it, but you never really seem to be chipping away at it. But as you get towards the tail end of the loan is where the big chunks of principal start coming off. Can you just explain how that works? Because people might not understand it.
Yeah, so I mean, a little bit hard to explain when we're not in front of people, but jump on a calculator and you can see like there's curves, for example, the bank calculators. Yeah, but I mean, at the start, paying a lot of interest. So what we're trying to do is help people pay off the principal, keep chipping away as much as you can, for example. And then once you get to the latter half of the loan, you're paying down big chunks of the principal. That's the end goal here. That's what we're trying to get people to. It's almost That's what they can see in the distance. We just need to try and make that happen. And then you work out how much interest you pay over the life of the loan. The faster you pay that back to a bank, the more money you're actually going to be saving yourself over the life of the loan as well. And the faster you pay the loan down, the more equity you got in there. So if you do want to buy another investment property, you've actually got more equity inside your investment property to then go again.
Yeah, so it's sort of savings there for a rainy day that you can use that equity to buy another property.
Yeah.
And it's probably worth doing the sums also. If you've got like a $300,000 loan, I'll just pluck that number out of anywhere. If that's a P&I loan at a pretty low LVR, you're going to get a pretty tight rate on that versus an interest-only loan at a higher LVR. So I've seen people do sums like this and paying at a principal interest versus interest-only, it might only be a difference like $50.
Correct.
$100 a month for a week, right? So, when you start looking at the difference of, having to put another $300-400 a month into a loan versus the benefits of it, it's okay to shift to P&I.
That's right.
I think we're sort of covered a fair bit there, mate.
We have, mate. And my message to investors is clear. Just know your numbers. Go back to the drawing board. Be very clear on if it's interest only, when it's going to expire, what that rate might go to, what those repayments in the future might go to. And I think having that knowledge is going to give you that confidence and be empowered to be a better investor.
Just looking at your bio here, so you're a wizard for a while, were you?
Correct, mate. I was there under Mark Boris and the team for,
Really?
for a while, and Brad Seymour. So it was an incredible time. It was almost the original disruptors when it wasn't a word back then.
Yeah, absolutely.
Yeah.
So, and then, because I first met you when you worked at the Commonwealth Bank. So did you go straight from there to the Commonwealth Bank, did you?
Yeah, I did. Yeah. So Commonwealth Bank, I was in terms of the marketing and product team there. So I do know how much banks make off a home loan. Which,
but you've seen it on the inside, right? You know
correct,
the mechanics
mate.
now? Yeah. So why mortgage broker? When did you go, all right, that's it, I'm going to go out alone and do it? Because look at some of these awards. It says you've been a Newcomer of the Year, Australian Broking Awards, National Young Professional of the Year. You're not that young anymore, are you?
Mate, a few more grey hairs from broking actually is courtesy of that.
So why broking? Why'd you get into it?
Yeah, look, my wife and I, we were on our honeymoon in Vietnam, and we decided that I think two things. One is broking gives us control of our future, our own financial future. So be able to live life on our own terms by running a business and running it very well. And the second part is around home lending. I think a lot of people, even going through the process ourselves, feel confused, feel a little bit intimidated. I won't say a little bit, they feel very intimidated by the process. You don't know who to trust. I mean, what I tell clients is you put a broker, a planner, an accountant, a buyer's agent, two sets of parents, friends and family and investors together. I think we're up to about 12 sets of conflicting advice on how to buy a property.
Yeah.
You can imagine what people go through, and if they're that confused, sometimes they don't even take action. So for us, I thought, how do we help people get on the front foot? And being a husband and wife team, we can then help and advise.
So you like each other as well, right?
And we have to. I think we love each other.
What's the genesis of the name of the business?
Atelier is it's a fancy French word for studio or workshop. So what we're trying to say is, how do we stay boutique-y?
Yeah.
And how do we do that in a fancy way? But mate, really, it's Australian for finance.
Okay, Australian for finance.
Yeah,
Is it?
Pretty much it. So.
All right. So I'm sure people can find you on the internet if they want to track you down. What's your website?
Atelierwealth.com.au.
Okay, cool.
We'll put it in the show notes as well. If you
All
want.
right, yeah, we'll do that. And this paper Aaron's written, I'm sure you're happy to give it to people if they want it.
Oh, no, absolutely. It's on our website. So you jump on there. We'll put the chart pack up as well. And this is what we want people to know, that this is heavily researched as well. This isn't opinion-based.
Yeah.
We want to show people that there's a lot of detail. It's going through RBA minutes. So for us, we're trying to make sure that we do a lot of, and this is our job, right?
Yeah.
To know what the market's doing, to do a lot of research. So for us, we're trying to have that research off people and show them a bit more insight.
And if this isn't on your radar, the expiry of interest-only loans, I'd put on your radar pretty quickly and actually understand the marketplace. Just at least know where you are, what's going on with your portfolio. It is getting more challenging to secure finance. If everything's in order, you should be okay. But to actually extend your interest-only period probably means you're going to have to do a new application. It's going to be looked at under the new servicing requirements, and a bank may say no. So make sure you're in control. Thanks, Aaron. Appreciate your time, mate. Very good.
Phil.
Let's get you back again on soon. If you've just found us, smartpropertyinvestment.com.au, go and check it out. Every single day there's more information around property investment that you can poke a stick at. If you want to make sure that you're first to know what's going on in property and property investing, you can subscribe to our daily morning newsletter, smartpropertyinvestment.com.au/subscribe. If you like social media, go and check us out there, Smart Property HQ, and keep connected with everything. And please keep those reviews coming on iTunes or wherever you listen to the podcast. You haven't done us a review yet, have you?
I will be doing that as soon as I
There you
leave.
go. All right. There There we go. Good. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.